I do want to start with the ad sales because those were phenomenal again, as they have been in the past, despite a lot of proselytizations that somehow this was all coming to an end. Were you pleased with this report in its totality?
Absolutely. We think so. First of all, thanks for having me. But yeah, absolutely. In terms of Q1, I would say based on what Google had printed and even Snapchat, even though we don't view Snapchat as a big read-through for Meta, and also large agency holding companies from Publicis to Group M, seemed like the first quarter for advertising was going to be largely fine. It was more about the second quarter guide. So the big takeaway here is the second quarter guide came in much better than feared. We were hearing at the high end, investors were expecting up to 44 billion in revenue, and it came in above those expectations. And also on OPEX, it's actually a positive that OPEX guidance was lowered by $1 billion. We actually would not be surprised if they lowered through the year. That's something that this management team has done before. And then on CapEx, that's a modest negative. So we'll be waiting to hear what they have to say, especially after Google reiterated their guide and Amazon is expected to reiterate their full year guide tomorrow.
So when it comes to the ad side of the business, though, too, I thought it was interesting. The average price per ad, that was up as was expected and above analyst estimates. I think it was up 10%. Street was looking for something like 7. Though ad impressions did miss. And I'm wondering, does that matter? I mean, it was up 5 versus 20 year over year. And I think the Street was looking for something like 7. Complicating or not?
I don't think it is a huge negative per se, in part because they will have other impressions and other surfaces that will grow. It's going to be a mix of both pricing as well as impression. And pricing, I would say, is kind of an output. But what is remarkable is actually that it is 10% growth in pricing, even when in 2024 we saw pretty elevated pricing level just because they've done so many product changes. So what it tells us is that there is demand for the platform, i.e. there is ROAS for advertisers, otherwise pricing wouldn't be this elevated, would not have grown 10%.
Shweta, how are you thinking about the challenges that Meta faces when it comes to its operations in Europe? Europe accounts for about a quarter of its revenue, at least as of last year. And there have been some violations and there have been some fines, which are fairly manageable for a company like Meta, but repeated violations will start to amplify that cost. And we heard from the company today that it is going to appeal the European Commission's DMA decision on the no ads model, and it expects modifications to its model based on the feedback it's gotten from Europe.
Well, that could potentially create a headwind in terms of an overhang, but I don't think that that will be resolved anytime in the imminent future. It's, if at all, it creates a multiple overhang, but not as much of a numbers overhang, just kind of like what we are seeing here in the US. So it may take longer than people give them credit for in terms of how long it would take for the appeal to go through them to actually go through the entire process. So I don't see that as an imminent risk to numbers, but more of a risk to multiple. The second thing is that I forgot to mention in my prior comment that investors will be looking out for their commentary on impact from tariffs and Temu and Shein and other APAC-based advertisers that could potentially be pulling back. But based on the second quarter guide, it's a surprisingly good guide.
Right. No, that's a really important point, especially given the reliance on those names like Shein, like Temu, Chinese companies in general, accounting for about 11% of revenue for 2024. We also heard from Meta that its outlook does include an increase in expected costs of infrastructure hardware. So there is that vulnerability to hardware costs, including things like its AR and VR hardware sales.
Yeah, absolutely. And then we will also be, just following up on that, investors will be looking out for commentary on headcount growth and where that is going to be coming from versus where they'll expect to see leverage in headcount. And Reality Labs actually could be one of those places where there maybe is greater room for headcount reduction.
So, I mean, based on what we know so far, at least just from the statement, and obviously we still have to wait for the call, how much can we read through? And let's just take the ad business. So I want to make the comparison with some of the other social media companies that have yet to report here. Do you think there's some read through from what we learned today out of Meta into some of those companies as well?
Well, first of all, I mean, we did hear from Google last week. They don't guide to second quarter, and then Snap yesterday. And so what is transpiring here is that Meta is not seeing as much of headwind, even as of second quarter guide, as perhaps some of the other platforms, specifically Snapchat. And that makes sense. They have better auction density. Can we take what they guided to in the second quarter and apply that for some of the other mid-tier platforms, including Pinterest? I don't think so, just because the auction density and the demand for Meta's as platform is arguably superior, in addition to them focused more on lower funnel advertising spend versus greater skew towards CPG, retail, and brand spend for Pinterest. So they still have greater risk than perhaps Meta does. And then the second thing is that while the second quarter guide is good, there is very limited visibility in back half. So if macro turns against them, Meta is not immune, and there's still this risk of downward revisions coming in the back half should consumer spend deteriorate.